And as they come up here, my name is Phil Kebb. I'm with IHG, and I help IHG grow our upper luxury brands, which are Six Senses and Regent. And I'll let Richard and Homi introduce themselves as well. Sir?
You go first because you're the big dude. I'm the little guy.
Thanks, Homi. Thanks, Phil. Sure, I'm Richard Stockton, President and CEO of Braemar Hotels. Braemar Hotels is a publicly listed lodging REIT. We've got about 15 luxury hotels. So think Ritz-Carltons. We have 4 of those. We have 4 Seasons in Scottsdale, Park Hyatt, Beaver Creek, and that's expanding almost 4,000 rooms. So I've been with the company 8 years, where I've grown the portfolio from 11 hotels to 15. We've sold some. Delighted to be here. It's my first time at this conference. Seems like a really great collection of interesting people and great topics to talk about.
I agree. Great conference. It's so damn different from the big boys in New York and Berlin and Hong Kong and, which is a cluster. You know what I mean. I'm Homi Vazifdar. I started the Canyon Group about 20 years ago, and we are a brand agnostic, ultra luxury owner. We own Aman resorts, several Amans we owned, and 4 Seasons. We are developing Six Senses. So we either acquire or develop from the ground up ultra luxury resorts, and we try to be market leaders no matter where we are, whether we are in Fiji or in the Canyon country or in Wyoming or just about any France, wherever we are, we try to be market leaders with rate and occupancy and the RevPAR, and that's who we are.
Good, thank you, gentlemen. And we have kind of 2 ends of the spectrum of hotel ownership represented up here. Richard's with a publicly traded company subject to all the rules and regulations of U.S. publicly traded companies, and with additional layer of complexity with the REIT rules and regulations, and so very institutional, if you will. The other end of the spectrum would be Homi, who is, I can say, non-conforming, if you will. And generally, most of his capital in his hotels is from high net worth individuals and family offices and very entrepreneurial related capital. So kind of 2 ends of the spectrum, if you will, as owners look at luxury hotels. So first question for each of you, and figure out who goes first, but what do you look for from an owner perspective when managing and or selecting your brands and your operators for your properties?
Yeah, sure. Thanks for that characterization. I sound like I'm kind of the boring one, and Homi can say whatever he wants.
Yeah,
right. Look, when we seek out new acquisitions, right? So we're looking at new luxury brands. The most important thing is, does the brand generate profit, right? And generating profit is top line and obviously controlling expenses. So we look for brands that have great distribution. Right, great customer experience, great guest experience that can drive the top line, the ability to push rate, but then also not be saturated in that market. But then on the other hand, we like brands that think like an owner, right? So they control expenses, they generate positive NOI margins. You don't always get that with luxury hotels because at the end of the day, as a REIT, we're in the business of buying assets that generate a return and then improving that return over time through our CapEx management programs, through our aggressive asset management, and we partner with the brand on doing that.
Homi?
Because we acquire as well as we build from the ground up. So when we acquire a branded hotel, but when we develop from the ground up, we don't necessarily pick a brand like most developers do and most private equity companies do early in the game. We pick a brand later in the game. And for those of you here in the audience that have dealt with brands, they are all pains in the asses. They are hard to deal with. They don't give a shit about the owner because it's the owner's money and it's their operating company, right? So these guys don't care. But we look at a brand purely from rate, distribution, price per square foot of real estate, And then the rest of it is, are they easy to deal with, which we know they're not. But if you have strong asset management, you manage it. Like, Aman is sort of the gold standard in ultra luxury. They are very hard to deal with because they are the absolute best. And our Amangiri in Utah that we own has the highest RevPAR in the United States. The tented product that we have there, the Camp Sarica, runs $5,700 ADR. So, we have to balance the good with the bad, right? We have to balance the arrogance with what they bring to the table. And as long as you can do that, as long as asset management can do that, then we are all happy campers.
Thank you. Having worked for brands much of my career and currently working for brands, I will defend us that from time to time we do care about the owner's money and the profits and all. But Homi, you touched on a point about the value per square foot. I'm assuming you're referring to branded residences that may be part of a new development. Talk a little bit about how you evaluate the brands relative to the ability to help you sell real estate.
Brand?
About how you evaluate the brands as it relates to helping you sell the real estate.
Well, yeah. So different brands have different, price points on real estate. Generally speaking, Aman has the highest. Six Senses also has a very high price per square foot on the real estate. And so then, but velocity is also terribly important in selling real estate. Now, let's go the absurd route. Aman sold in New York, which is a very different product than our Amans and our resorts. They are all resorts. In New York City, they were selling residences at $14,000 a square foot, which is kind of obscene, right? So we try to hit north of $3,000 a square foot, and that is reasonably achievable. And then what we tell the brand is, for every incremental $250 a foot, they get a stepped up basis. And so that's how we manage it. We have failed, we have succeeded, but at the end of the day, if you're looking at the financial part of it, and if you go into a resort and your mindset is about, let's say 18% IRR, depending on how you sell your real estate, that then suddenly becomes a 30 to 32% IRR. So that's really, really critical and important. So you've got to, again, balance the price per square foot with the velocity.
So it really drives the returns for the investors. Richard, at Braemar, I know you guys have got the highest RevPAR of any other U.S.-based REIT relative to your hotels, call it the gold standard, if you will, from a standpoint of top-line performance. You mentioned in your comment a moment ago about operators or brands that think like owners and care about owners. We're all familiar with the huge increase in ADR and RevPAR that occurred kind of in a post-COVID world. I think read recently from 2019 to maybe it was 2023 or maybe trailing sometime this year, is RevPAR is up in a 30-35% range, which is great from a hotel owner's perspective. But what do you see happening on the cost side that becomes the other part of that equation to get to the NOI that you're thinking about? What are you seeing happening in that regard?
Yeah, in the aftermath of COVID, we did something for the first time that we hadn't done before, which is segment our portfolio into resorts and urban properties. And the reason we did that is because they took on very different complexions in terms of their behavior, in terms of rate growth, and in terms of expenses. And we thought it was more valuable now to look at it that way. It didn't really matter as much before 2019. So what we saw was, starting in June of 2020, our resorts really started to take off, and the urbans just were still lagging. That peaked in the middle of 2022. And then from 2022 to now, rates have slowly come down on the resort side because the air is being let out of the COVID balloon, all the stimulus money, et cetera, that was fueling that. Whereas urban continued to go up and continues to be, now is our engine for growth. On the expense side, only one thing has been true. Expenses just keep going up, right? They keep going up, and they've kept going up since 2020. We saw a huge surge in costs, related to property taxes, related to insurance. It appears that those have subsided now, and for two different reasons. On the property tax side, the municipalities were trying to scrounge for any amount of revenue they could get in order to recover from COVID. On the insurance side, we were hit simultaneously with a couple, with several loss events, whether it be weather-related or otherwise, that put up insurance rates. Those have now come in line to kind of mid-single-digit growth is what we're looking at now. And then, of course, labor, right? So labor also, huge inflation in labor cost. That is in part driven by regulation, and there are a number of minimum wage regulations that were rolled out across our cities that are slowly folding into place. They've already started, continuing the next couple of years. And then, this is just leading to an overall surge in costs and a erosion of margins. Now, the good thing is we've had very high rates the past couple of years, so that's offset any margin erosion. But I think now it's starting to catch up a little bit, and we're probably back to margins that we were seeing in 2019 after having experienced some improvement in margin, probably about 10% the last couple of years.
You mentioned the fall off in some resort average rates or RevPAR that you've seen since, I think you said it peaked sometime in 2022. Homi read statistics, the line of, uber high net worth people globally is doing this, which is driving that very, very high end travel. In what you might define as some of the ultra luxury hotels you're doing, what are you seeing happening relative to rate occupancy and RevPAR at that very, very highest sector?
Okay, so during the pandemic, it was almost embarrassing because we were having, in the middle of the pandemic, we were having our best years. And in the middle of the pandemic...
But a point to be clear, most of your assets are in the resort sector as opposed to...
Yeah, they are flight to safety.
And resorts.
And so on and so forth. So they're out in the booties. And so we also, in the middle of the pandemic, we opened this tented camp. And we were doing $5,700 ADR at 100% occupancy throughout the pandemic. So then what happened was, because all our resorts were, considered flight to safety and out in the booties, many of them would drive to or private jets and things like that. So we were okay. Now what's happened is, like Richard was saying, the COVID aberration kicked in, and we have seen a decline, not in the ADR, but in the occupancy by probably 8 to 12% since the peak of the COVID and the peak of the rates that we had. And talking about the expense side, now if you're trying to build a hotel, that's a whole different story. First of all, you're spending $2.5 to $3 million a key to develop these hotels. And then labor is it's a bitch to get good labor. There is such a shortage of labor. Interest rates are through the roof now. I realize that the life of a resort is 30, 35 years, 40 years, 50 years. So, 3 years of high interest rates is not going to kill you, but it's high and it hurts the owners. The operators don't care so much, but it really does hurt the owners. So we are also trying to play catch up on the expense side coming out of COVID. And I think there is a new barrier. And there is a new threshold for cost of material, cost of labor, cost of construction, and in general, cost of everything. Insurance, if you are in Napa Valley, you are just screwed. The insurance rates, if you are lucky to get insurance, it is just crazy.
But I would add on a new development, because we do look at new developments. We haven't taken on one just yet because we're trying to make the numbers work. But I've come to the conclusion the only way a new luxury hotel development works is you get one of two things. You either get a subsidy from the local municipality, and they are aggressively looking to deploy tax revenue to help you build these hotels. Or you're able to build branded residences and sell them at extreme premium to make the numbers work.
Yeah.
The idea of just building a hotel without residences and without public help, the numbers just don't work. They just won't work.
Yeah, and I would agree with that. I've said for, last couple of years, other than the Kingdom of Saudi Arabia, where all these luxury hotels are popping up because they're trying to build a tourism business, in mainland China, there's very, very few new luxury hotels being built that don't have some component of branded residences to offset that cost and all. Richard, Homi talked just a moment ago about the development costs going up, rising. I mean, a lot of the capital that you guys deploy is back into the existing assets. Yep. Where are you seeing costs relative to renovations, redo of rooms, expansions of food and beverage, whatever those CapEx projects may be, but where are you seeing those costs coming out now?
Well, I'll tell you, we look at everything on an unlevered IRR basis, right? Because in doing that, you're capturing the incremental yield that your CapEx initiatives are generating, plus the benefit in the terminal value to the value of your asset, right? And when we look at an acquisition opportunity of a hotel, we underwrite to a minimum 10% on levered IRR. When we look to put additional CapEx into our existing assets, that threshold is generally 15% or more. So a good example will be a grab-and-go market, right? So we've found that putting the grab-and-go markets in your lobby is incredibly ROI accretive. And we can drive 18, 20% unlevered IRRs from putting in those markets. And you're repurposing bell space, or you're repurposing part of the concierge area or something. But guests want it, it's easy for them, it generates a high return. And so that's kind of our benchmark. And we'll apply that same approach when we look to do conversion of, say, meeting space to rooms or any other amenitizing in terms of CapEx projects.
With this question, maybe have Homi, you address it kind of from new development, new construction standpoint, and Richard from the standpoint of existing hotels and renovation. Been lots discussed up here today and reading in the press about luxury hotels, about the experiential travel and about wellness and well-being and longevity. Goldman Sachs had a report come out recently and talked about how they believe that the luxury sector is going to grow much faster than kind of the mid sector, if you will. A lot of that being driven by, Gen Zs that are really focused on this experiential thing, plus in addition the wellness and the longevity. Homi, what do you say when you're developing something new? What's the focus on that today versus what it may have been when you did the Aman 10 years ago?
You can talk till the cows come home about that. But seriously, when you are in our sector, luxury is luxury. And then you have the greatest generation, and you have the Gen Zs and the Gen Ys and all these guys, and they say some of them are lazy, some of them are not, some of them want to work, some of them don't. But at the end of the day, since we all deal with the tip of the pyramid, service becomes absolutely critical. I mean, service is unbelievably critical. Over and above that, you provide them the one gravitation that we've seen from the old ultra-luxury resorts around the world, and Asia is the hotbed of ultra-luxury resorts. That's where they were invented, literally. Is it now they cater more to families than to individuals. These ultra-luxuries were considered honeymoon resorts or couples getaway. Not anymore. Everybody wants family-centric resorts, and so you have to, again, arrive at a happy balance between the honeymooners and the family. So that is the most critical thing. The spas and the various kinds of accoutrements and the adventure and all that stuff, they were there before. They're there now.
I mean, I'd be a little less diplomatic than you, Homi, which is rare. Which is...
Everybody brace yourselves. This may be the first time this has ever happened with these two.
No. Well, just in terms of wellness, right? It's a great buzzword. Operators love it, right? We can sell this on the website, get more people in. people, particularly Gen Z, go on vacations, a couple times a year. If you're only focused on wellness and longevity a couple times a year, you're not going to live very long, right? It has to be part of your lifestyle at home. That said, yes, offer the spa, but we've been asked by operators to invest tens of millions of dollars into massive kind of wellness facilities, and the numbers just don't work. Right?
They're not passing that 15%.
We're not, yeah.
Cash on cash ROI.
Because you don't have someone spending $1,000 a night on a room and then spending another $1,000 a night for wellness, right? So the incremental revenue that you can charge is not going to get you there. Wellness and longevity is great. That's what people should be doing every day. They should go to the gym. They should eat healthy and all that stuff. You don't need to necessarily do it at our hotel. In fact, come to the hotel and do the opposite, right? Eat like crap, drink too much, hang out by the pool. That's a good time at a luxury hotel.
See, here's the thing. You're going to spend $2,500, $3,000 a night. I am not friggin' going to eat celery. Okay, I'm not going to do that. I'm going to eat red meat. I'm going to do things that are really, really not good for me, and then screw the rest. Yeah?
That's the anti-wellness crowd clapping.
Yeah, I was about to say,
Did I piss off a whole bunch of people here?
But it's the reality coming from people that invest and own in luxury hotels, so it's important to listen to. We can't have a conversation about ownership of luxury real estate hotels without talking about cost of capital, interest rates, and all that. Richard, you've talked about your 10%, cash on cash for an acquisition, 15% for ROI. Homi, you made a comment about interest rates being sky high. The newspapers I've read the last 3 months say that they've come down 75 basis points. Base rates come down 75 basis points. Homi, maybe start a little bit about how you see the cost of capital and sources of capital when you're doing new development.
Yeah, you cannot go to a conventional bank anymore. You got to go to private equity. These are the money bags. These are the dudes that have all the money in the world. We guys, we small guys are always, we're always scrambling for good debt. On the development side, we never exceed greater than 50% loan to cost, because that 50% loan to cost becomes 65% loan to cost when the resort is open. The budget is unlimited and we still exceed it. So, it's kind of so weird when you start these developments. And now with the interest rates now north of 7%, it's painful. It's painful. So what you do is you don't borrow more money, you raise more equity, but you raise patient equity. And that's what we do.
Richard, what are you seeing happen with your change in interest rates, what it's doing for you guys from a standpoint
of
the performance of the REIT?
The Fed is getting what they wanted, right? They wanted to slow things down, put the brakes, shut people down, and they shut us down, right? We had interest rates go up in the way that they did. Our interest expense tripled. Now that was because we were primarily floating rate debt. We still are. But what does that do? That just eats up our excess cash flow. That means that we can't go out and buy more hotels, right? Which is what the Fed wanted, right? So we're adhering to their wishes, and we've slowed down our acquisitions. We're focused internally on CapEx projects, asset management, these types of things, deleveraging, and then as the Fed starts to cut rates next year, then we can start to slowly apply the foot to the gas and start looking at more opportunities to develop in conjunction with existing assets. We have a couple of projects on the drawing board for that, and then we can also look at new acquisitions. But we've got to wait for the Fed to give us a green light.
Okay. Lots of talk about glamping or tented camps or whatever term one might want to use for kind of that alternative lodging product. Richard, any of your existing hotels, do you have any of that, and are you evaluating any of it in some of the existing assets?
We are. We have the Four Seasons in Scottsdale, which has a 10-acre site that is being currently designed for a tented camp. So it would be a ultra luxury add-on in a kind of separate area of the Four Seasons that would have 18 tented villas that are 1 and 2 bedroom, their own separate pool, separate amenity area where you'll have a restaurant, you'll have fitness, but then they also have access to everything at the main Four Seasons resort. And we found, and Homi led the way in this with Camp Sarika, which I'm sure he's about to talk about, but he's mentioned. This is a great experiential product that people are willing to pay a significant premium for.
And I'm assuming it's passing the 15% ROI hurdle that
Yes.
your expectation has. So,
Yeah.
so now Homi can talk about the great success that he had at the Amman, what he did with that.
Right. So it costs about 60% of what it costs to build a brick and mortar, and the ADR is almost twice. So it's like, but see, in Africa, in Southeast Asia, in India, this concept has matured. In the United States, it hasn't. The luxury part of it hasn't, and therefore we did a proof of concept. And we were very afraid, and we spent $1 million a tent. And we were really scared that this will blow up in our face. Instead, it's quite the opposite happened. So now we are building a 40 keys tented cab, 1 bedroom and 2 bedroom, again near Zion, but with bricks and mortar public areas and residences, but canvassed tents. And the pro formas are, of course, the last person you want to lie to is yourself, but the pro formas are coming out pretty nicely, so we'll see what happens.
So it's fair to say you're able to raise the capital to do those, you think?
We have raised capital, yes. We were very lucky that we are raising our second fund, and we've had some success doing it. 40 years ago, when all of us went to Wall Street to try to raise, when we were an ex-investment bankers, and we started this company, and we went to Wall Street, and very, very important people on Wall Street said, "You're a friggin' idiot. You're going to lose all your money, and you're going to lose your investors' money, because you cannot build 40 key ultra-luxury resorts in the middle of nowhere, because nobody's going to come." These same people now have to beg for rooms because they can't get the rooms. So yeah, it's a very proven concept now that boutique hotels can. How many keys is Bardessono?
65.
There you go.
And where's that hotel?
Is what?
Which hotel are you referring to?
The Bardessono is a property in Yountville in Napa Valley.
Napa Valley.
And it's operated as an independent without a brand.
It's independent, that's right. Yeah, and it's kind of a spa concept. What's interesting about it is it's an all-suite property, and so you can get your spa treatments in your room because the bathrooms are a size where you can just roll in the bed and do the massages there and that sort of thing.
That can lead into a question, Richard, real quick. That's obviously independent, non-branded, not tied up to one of the big brands to feed into it. Talk a little bit about the dynamic of that versus a branded hotel and how you evaluate that in your decision.
Look, I think that there's some people are one camp or the other, right? We don't like to brand managed, only franchised, or I'm very situational specific, right? I think for each hotel you have to evaluate. Can the brand bring value? Is a distribution system necessary to drive demand? Because that's a lot of times what a property needs. Many properties that have a location that's very well known, there's already a following. You don't necessarily need that distribution system. Yountville fits in that category. By having, dare I say, Marriott brand, we love Marriott. Dare I say, Marriott brand on your property is not going to bring more people to Napa Valley. They're going to go to Napa Valley regardless. But if you are in a place that is relatively unknown, that's a great way to advertise and drive demand.
And Homi, in what you're doing, I understand some of the things you're looking at are not going to be tied to a recognized luxury brand.
No. We're unlike. See, that's why he's a smart guy. We think we need brands. we are brand chasers. We just chase brands, and it doesn't matter whether we are in Napa Valley or whether we are in the Canyon Country or in the middle of nowhere. We think it's a lot easier because we're a smaller company to get a brand to come and manage our assets, and especially if you're going to sell real estate, I think the brand has a huge uptick in price per square foot on the real estate, and that's neither right nor wrong. It's just our policy.
You know, and some guests like the unbranded experience. They prefer that.
Totally.
And they seek that out. Or the very small brand, like an Amman. And so that's a differentiator, and that drives a rate premium. It really depends on the situation where you are.
I heard a couple things here. One is, just like real estate, location, and from your perspective about, depending on where you are, whether it's branded or non-branded, Richard, and then what brand it is if you decide to brand, and then Homi, hearing you say that you got to sell branded residential to make the numbers work in new development, you need the brand to help do that. So.
And so therefore we are not necessarily driven by bullseye demographics. You know, we have dropped resorts in the middle of nowhere, and because we had the backing of a great brand, it worked.
Yeah.
And so we because of the real estate and because of the rate, we chase.
But some people want to be in the middle of nowhere, right? You go to Amangiri,
Totally.
You want to be in the middle of nowhere.
Yeah.
Well, I see our time is about up, and Homi, thank you very much. Richard, thank you very much for being here. And with that, we will conclude things. Thank you.